In an earlier video, I showed you how to account for a sale and leaseback transaction in the books of the seller-lessee in a situation where the sale is made at fair value. In this video, I'm going to demonstrate how the seller-lessee will account for a situation where the sale and leaseback transaction is below fair value. Let's go through this question. City Limited entered into a sale and leaseback on 1st January 2019. It sold an asset with a carrying amount of 100,000 Ghana cedis for 200,000 Ghana cedis. So the carrying amount is 100,000 and the sales value or the sales proceeds is 200,000 Ghana cedis, and leased it back over a 5-year period. This is the lease term, equivalent to its remaining useful life. The asset had a fair value of 300,000 Ghana cedis prior to the sale. The transaction constitutes a sale in accordance with Ifrs 15 revenue from contracts with customers. The lease provided for 5 annual payments in arrears of 50,000 Ghana cedis. The rate of interest implicit in the lease is 5%. So you are required to pass a journal to record the transaction on 1st January 2019 and also prepare extracts from the statement of profit or loss and statement of financial position at 31st December 2019. Alright, so this is a sale and leaseback transaction. Where the sale is below fair value. And the caveat is that the sale meets the IFRS 15 criteria. Okay, so that means that this represents the satisfaction of a performance obligation. Okay, this sale is a situation where performance obligation has been satisfied by the seller. Alright, so in a situation where there is sale and leaseback below fair value, you have to go through 6 steps in order to journalize the transaction on the date on which the transaction took place. So we're going to go through 6 steps in order to journalize the transaction. First of all, the seller-lessee. In this situation, the seller-lessee is City Limited because it owned the asset earlier and then it sold it and then it's now leasing it back. So the seller-lessee is City Limited. This is how City Limited is going to account for the transaction. First of all, it has to recognize the sale proceeds. Then, secondly, he has to derecognize the asset. When you sell an asset, the 2 double entries to make is to recognize the amount of money you receive, and then you derecognize the asset you sold because now you don't control it again, so you don't have to keep it in your books. So this pertains to the sale of the asset. The third thing to do is to recognize a prepayment. Recognize a prepayment. When the sale is below fair value, you recognize a prepayment. Fourth, we're going to recognize a lease liability. And then you recognize a right of use asset. this part pertains to the lease, because City Limited is selling it and then leasing it back, and under IFRS 16 leases, at the commencement date of the lease, the lessee should recognize a lease liability and a right of use asset. Then finally, the seller-lessee should recognize a gain or loss on transfer. So after recognizing the first 5, you recognize a gain or loss on transfer as the balancing figure. So this only serves as a balancing figure in the journal. Alright, so in A, we are required to pass a journal to record the transaction. So let's prepare the journal. The name of the company is City Limited. So we have City Limited. Then we are preparing a journal for City Limited. So that is requirement A. We have debit and credit. Ghana cedis here, Ghana cedis there. Alright, so the first thing is to recognize the sale proceeds, and this may be in the form of cash or bank. Alright, in the question we are told that the asset was sold for 200,000 Ghana cedis. So that is the sale proceeds. So we have 200,000 here. The next thing is to derecognize the asset. So we are going to take the carrying amount of the asset off from our books. And according to the question, the asset had a carrying amount of 100,000 prior to the sale. So we have PPE, that is the asset. If we are derecognizing an asset, then we credit it, okay? Because assets have normal debit balances, so we credit it with 100,000. The next thing to do is to recognize a prepayment. Recognize a prepayment. Okay, in this question, we are told the fair value of the asset is 300,000, and the assets was sold for 200,000. Okay, so IFRS 16 says that because the fair value is higher, it is higher than the selling price, the difference between the fair value and the selling price is the prepayment. So prepayment here is the difference between the fair value of 300,000 and 200,000. And that gives us an amount of 100,000. Okay, on the market, the asset is actually worth 300,000, but then the seller-lessee is taking 200,000 for the assets. So the fair value is 300,000, but the seller-lessee is taking 200,000. So according to the standard, this means the seller-lessee has prepaid the 100,000, because instead of the seller-lessee to have collected 300,000 in full, he took 200,000. So the 100,000 represents a prepayment. Okay, a prepayment. So we recognize a prepayment. Prepayments are assets. A prepayment of 100,000. The next thing is to recognize a lease liability. So we have lease liability. You have to do a working on that. So at the commencement date, the lease liability is measured at the present value of all lease payments that have not been made. Okay, so we are going to multiply the annual lease payment by the annuity factor. In this question, we are told the annual lease payment is 50,000 and payment is made in arrears, that is at the end of the year. So we multiply the annual lease payment of 50,000 by the annuity factor. The formula for finding the annuity factor is 1 minus 1 plus r raised to the power negative n all over r, where r is the interest rate implicit in the lease and the n represents the number of future lease payments remaining. So in this question, we have our interest rate implicit in the lease to be 5%. So that is 0.05. And we are told lease payments are made in arrears, that is at the end of the year. This means that at the commencement date, which is 1st January, City Limited hadn't made any payment, so it has 5 lease payments to make in future because the lease term is 5 years. So you raise it to the power of -5. Then you divide it by r. R is 0.05. So we have 50,000. You multiply it by the annuity factor, 4.3295. When you round it to the fourth decimal place, this is what we get. The product of these two numbers gives us 216,475. So this is the lease liability we have to recognize. Lease liability. The liability has a credit balance, so we have 216,475. The next thing is to recognize a right of use asset, that is the fifth step. So we have right of use assets. Let's do a working for that. So we have right of use assets. We find the right of use assets by dividing the lease liability by the fair value of the assets then we multiply it by the carrying amount of the assets. We just calculated the lease liability and we got a figure of 216,475, so that would be the numerator. And in the question we are told the fair value of the assets is 300,000. So we have 300,000 here. And we also told the carrying amount of the asset was 100,000. This gives us a right of use assets of 72,158. 72,158. So we go and record it in our journal. Right of use asset is an asset, and assets have debit balance. So we have 72 158 here. Then now what we do is to sum up the debit balance and the credit balances and see which side falls short of the other. When you do the summation, you realize that the credit side falls short of the debit side. So we have a gain. The difference will appear at the credit side. So it is a gain on transfer. This is the balancing figure. And we have an amount of 55,683 as the balancing figure. So this answers requirement A. In requirement B, we are told to prepare extracts from the statement of profit or loss and statement of financial position. Alright. So as you may already know, Ifrs 16 says that lease liabilities are subsequently amortized. So we are going to amortize the lease liability. So we have subsequent measurement. We prepare our amortization schedule. So we have our year. We have our opening lease liability. We have the finance cost, which is calculated by using the interest rate implicit in the lease. Interest rate implicit in the lease of 5%. Then we have our lease payment. The next thing is the capital repayment. Then we have our closing lease liability. We underline it and bring our Ghana cedi sign here. So the first year is 2018. We realize that the opening lease liability is 216,475. So we begin with that figure. So we have 216,475. We find the finance cost by multiplying 5% by the opening lease liability, and that gives us 10,824. That is, we've rounded it off to the nearest whole number. This lease liability, according to the question, or the lease payment at the end of each year is 50,000. So this is an outflow, so we put it in brackets. Then the capital repayment is found by subtracting the finance cost or netting off the finance cost and the lease payment, and this gives us a figure of 39,176. And then we find the closing lease liability by subtracting the capital repayment from the opening lease liability. Subtract the capital repayment from the opening lease liability, and that gives us a closing lease liability of 177,2 299. Then we come to 2019. Sorry, the first year is 2019, and the second year will be 2020. So we have 2019 and 2020. So the beginning balance will be the closing balance for the previous year. So we have 177,299 over here. We multiply 5%. You multiply the figure by 5%, and that gives us 8,865 as our finance cost. Then you subtract the annual lease payment of 50,000. When we net off the finance cost and lease payment, we get a capital repayment amount of 41,135. And then we subtract the capital repayment from the opening lease liability, and we get an amount of 136,164. The question requires us to show extracts for 2019 alone. So it means when we get to 2020, we can stop with that. For the right of use asset, we are going to depreciate it. So depreciation of right of use asset. Subsequently, we are going to depreciate it. That is, if it is a depreciable asset. Alright. So depreciation charge is calculated as the cost minus residual value divided by the estimated useful life. In this question, the right of use asset we recognized was 72,158. We don't have any residual value, so we have 72,158. So the numerator will still be the cost. Then you divide it by the lease term of 5 years. And this gives us an annual depreciation charge in respect of the right of use asset of 14,432. So annual charge, annual depreciation charge. So having done this, we can go on and show extracts in our financial statements. The name of the company is City Limited. So we are showing extracts from the statement of profit or loss. So we are doing for only 2019. Alright. So we recognize finance cost. These are expenses. So we put it in bracket, you show it as a debit. When we refer back to amortization schedule, the finance cost for 2019 is 10,824. So we have 10,824. And then we also have depreciation. Depreciation too is an expense. We had a depreciation charge of 14,432. So we have 14,432 here. And then when we were doing the journal, we realized we had a gain on transfer. A gain on transfer of 55,683. This is a gain. So we go and recognize it in the statement of profit or loss. So gain on transfer of rights. Since it's a gain, we are going to record it at the credit side, so it's a credit. And then the figure we had in respect of gain was 55,683. Alright, so we are done with the statement of profit or loss extract. Then we show extract for the statement of financial position. So we have extracts from the statement of financial position. So we have our Ghana cedis here. And we have assets. So under asset we have a right of use asset. The cost of the right of use asset, like we calculated earlier, was 72,158. Said we are going to charge an annual depreciation of 14,432. So we subtract that from the cost, and that gives us a carrying amount in respect of the right of use asset of 57,726. Then we come to our liabilities. We have current lease liability, and non-current lease liability. Let's refer back to amortization schedule. You realize that in 2019, the closing lease liability, the closing balance for lease liability is 177,299. So this is the gross closing lease liability. But then we can split this balance into its component parts. It contains a current component and a non-current component. Okay. The difference between the closing balance for 2019 and 2018 is the current component of the lease liability. So when you subtract 136,164 from 177,299, you get a figure of 41,135 as the difference, and that is the current component. So we have 41,135 as the current lease liability, and then 136,164 as the non-current lease liability. When we sum up the two, we are going to get the closing lease liability of 177,299. So these are the components of the closing lease liability. So we have 41,135 and 136,164. This brings us to the end of the tutorial on sale and leaseback transaction where the sale is below fair value. If you haven't subscribed yet, please subscribe to the channel, like, comment and share my videos for the perusal of those who may need them. Thank you for watching the video and have a great day. Bye.